It's Wednesday, December 6th, 2023. Please make sure to like this video, share all my videos, and make sure you subscribe to this channel. I want to get right into it today. They are really trying to shovel the manure with this so-called good news. And I'll start with this first article from Fox Business today. Mortgage demand jumps again as rates fall to lowest level since August. So we're supposed to believe that this is great news. I just checked bankrate.com 5 minutes ago on a 30-year fixed mortgage. It's 7.43%. To refi on a 30-year, 7.57%. So this is the good news today that they're shoveling to us like a big pile of manure. That this is great news. Go out, buy a house, refi your house. The decline in rates has helped to spur more housing demand. Applications, get this, are up 35% for the week. Now, I wonder, out of all these people applying for a mortgage, how many will actually be able to get approved? How many actually truly qualify? But this number is down 17% compared to the same week last year. 17%. Demand to refi, get this, surged 14% from the previous week and is up 10% from the same week a year ago. Now, this to me is very, very concerning, because who would be refining their home at this rate other than people who were this desperate? The people who mainly right now, the majority of people who are going to refi at this rate, at this time, in this environment, these are the people who are broke. These are the people in trouble. This is desperation. You're refining your house at 7.57% plus, you're in desperation mode. Here's another one. Mortgage refis, demand jumps 14% as rates fall to lowest point since August. This on CNBC. Now, I want to go back to something that when we look at mortgage rates today of about 7.5%, that's with 20% down. That's with excellent credit. These are normal rates. And what they continue to tell us is that, well, we need rates to drop in order for people to get back into the real estate market, to get back into the housing market, to go back and refi their homes. No, what we need is not rates to go down, because, you know, 7, 7.5, 8.5, 9%, this is normal. What isn't normal is when a house is going up 30, 40, 50% a year. And you have a house that just a few years ago was $250,000 and now it's over $500,000. That's what is not normal. This is abnormal. So we don't need rates to go down. What we need is the prices of homes to go down. Otherwise, you're going to continue to create bigger and bigger bubbles. And this is why we have a housing bubble right now, because people could go out and buy more house than they could actually afford, because they were getting a rate at 2.65, 2.75, 3%, 3.25. So they're able to buy much more house than they could truly afford. But now they've taken on, they've paid much more for the home. So they've taken on much more debt. And now they're stuck in these homes, unable to sell. That is until they lose their jobs. But getting back to this article, mortgage refis, demand jumps 14% as rates fall to lowest point since August. Well, this is supposed to be great news. This just tells me that we have a lot of desperate people, a lot of people who have hit the wall, who are broke and have no choice now but to refi their home at over 7.5%, 8%. Very, very dangerous. When people have tapped out the equity in their home, when they've tapped out the credit cards, there's nowhere else to go. And this is what's happening. Here's an interesting one on CNBC. IRS rejects more than 20,000 refund claims for the health crisis related tax credit. So no refunds for these businesses or these people. People right now are struggling to even pay their taxes. This is going to be more big trouble. So think about the businesses that were expecting these refunds. Think about the individuals that were expecting these refunds and they got rejected. Now, what are they going to do without those refunds? They're going to be even in more trouble than they thought they were. So very, very interesting. Here's another one on CNBC. Private payrolls increased by 103,000 in November, below expectations. The expectation, I believe, was about 128,000. That was expected. That number will probably be revised down. October was revised down to 106,000. And now we're at 103,000 for November. This number will probably be revised down under 100,000. Not a good sign for the economy and not a good sign for the housing market, because if we're not adding jobs, then how in the world are people going to afford to buy houses, especially at these rates? Another one on CNBC. Walmart CEO says consumers may not be as resilient next year, even as deflation starts to show. Newsflash, the consumer is not resilient now. The only thing they have is credit cards. I think that there's a misconception here where that if the consumer's spending, they're resilient, but they don't tell you how they're spending and what they're using to spend. Buy now, pay later plans and credit cards. Does that mean the consumer is resilient? No, that means the consumer is resorting to desperation of buy now, pay laters and credit cards and getting themselves in a very, very big trouble. A CNBC interview with the CEO of Walmart, Doug McMillon. In this interview, he said consumer spending is tougher to predict next year because of rising credit card balances and dwindling savings. Well, we have a savings rate here in America of around 3.5%. Think about after people pay their bills, after they pay Uncle Sam, that leaves them, after $100, it leaves them with $3.50 left to save. After they paid off all their bills, their taxes, they've got $3 left. How in the world does this support economic growth? How does this support a housing market? Deflation, he said, has brought down the prices of some general merchandise items, such as toys, he says. Well, isn't that wonderful, ladies and gentlemen? Toy prices have gone down. Big screens have gone down. Airline tickets have gone down. Now, isn't that wonderful? Now you'll probably be able to go out and buy a house now because of all this deflation that's taking place with toys and airline tickets and big screen TVs. Now people can go out and buy a house. Here's another one today from The Hedge. Hospitality jobs tumble for first time in almost 3 years as ADP disappoints. Manufacturing saw the biggest job losses, but leisure and hospitality lost jobs for the first time since February of 2021. This is a bad sign right here. But what's even worse is manufacturing saw the biggest job losses. Do we even manufacture anything in this country anymore? And yet it's showing the biggest job losses. And then, of course, the new career in America is leisure and hospitality, working at restaurants, working at bars, making coffees, all that stuff. And now we're seeing job losses for the first time since February 2021. Not good. Restaurants and hotels were the biggest job creators during the post-health crisis recovery. That boost now is way behind us, ladies and gentlemen. You know it's getting bad when you're losing jobs in leisure and hospitality. So we've seen it begin in tech, and now it is in the simple jobs in America like leisure and hospitality, which unfortunately many people have been forced into this new career path of leisure and hospitality. A career path of flipping burgers, folding towels, a career path of cleaning hotel rooms, a career path of making coffees. This is the new America. And now these jobs are beginning to be lost. And this is going to be more trouble. You know, reading this stuff does not make me happy, ladies and gentlemen. It is really, really sad to see what is happening to the average American, what's happening to families, especially the middle class, the poor. It's really, really sad. It's concerning because this is just the beginning. This is just the beginning. We have no idea how bad this is really going to get, but I'm prepared for it to get very, very bad, and I hope you are too. Here's one from the economiccollapse.com. They're calling this layoff season. And I have to ask all of you this question: is your job safe? Nobody's job is safe. Nobody is immune from this depression that has begun. And this is why you've got to put at least 6 months cash reserves away, hopefully a year. You got to get the debts paid off, get the cars paid off as fast as you can, get the credit cards paid off, zero balance, get the debts paid off, because if there is an emergency, if you or your spouse loses a job, if you have 6 months cash reserves put away for the bills, you don't have credit card debt, the cars are paid off, you're not going to go in panic mode. And that's the whole idea of being prepared. That, you know, if the boat, you know, hits something and it's taking in water, you have a life jacket and you're going to buy some time. What happens to people that have no money put away, who are floating a lot of debt right now, and they lose a job tomorrow, their spouse loses a job, they're going to be in panic mode, because immediately they're not going to be able to make the house payment. They're not going to make the utility payment. They may not be making the car payment. They're not going to last very long, because they're paycheck to paycheck to paycheck. And many people aren't even paycheck to paycheck now. Now they're, you know, using buy now, pay later plans. They're using payday loans just to bridge the gap from payday to payday. They miss a check. Their spouse misses a check. It is game over. You do not want to be in this situation. So, I mean, it may take some sacrifice, that you're cutting out, you know, the weekend dinners, going to the bars, taking the vacations, but you got to have a stash of cash. You got to have a cash reserve in order to buy time in case you or a spouse loses a job. According to the Bureau of Labor Statistics, there were more than 13 million layoffs and discharges in the U.S. during the first 9 months of 2023. And now layoff season has arrived. As the end of the year approaches, companies start looking at their bottom line, and they're going to take a very, very hard look at the bottom line. You're going to see more companies running lean, cutting the fat, right? You're seeing this all over tech right now. You're seeing the banking industry do this. It's all about the bottom line. You aren't going to matter. It's all about the bottom line. And after the holidays, and remember, during the holidays, a lot of companies add on workers, a lot of part-time workers for the season. Once January hits, a lot of those people are gone, and these companies are going to take a very hard look at the bottom line and expect the first quarter of 2024, you're going to see a lot of layoffs, because a lot of companies are going to be running very, very lean. And we've already seen it begin, right, over 2023. This is a warning to everybody. You've seen the auto plants lay people off, trucking companies laying people off, media companies laying off, people in tech, banks, music streaming giant Spotify is laying off 17% of its workforce. And now, as I just reported, leisure and hospitality is losing jobs. So you're going to see less people able to go and get a job in leisure and hospitality. But yet they're telling us that the outlook for the economy is great. The outlook for housing is positive. Buy a house, go buy a car, everything's going to be fine. According to what I'm reading here right now, this is all this news came out within the last 24 hours. Things don't look too good. Markets across the board today were very, very flat, but who cares? The markets are completely detached from reality. You live in reality. I live in reality. We got to go to the gas station, put gas in the car. We got to go to the grocery store. We got to buy food. We got to put food on the table. We got to buy clothes. We got to pay utility bills. We got to pay car repairs. We got to pay insurance. We got to pay all this stuff. We live in the real world. And if you live in the real world, you know that what they're telling us on the television is completely untrue. Things are not good. People are hurting. Everybody, for the most part, 90% of this country is feeling some pain or struggling. The top 10%, they're doing fine. But 90% of this country has felt a little bit of pain, or they're feeling a lot of pain. The money supply continues its biggest collapse since the Great Depression. And I'm going to finish with this article on the hedge today. Money supply growth fell again in October, remaining deep in negative territory after turning negative in November of 2022 for the first time in 28 years. This after an unprecedented high during much of the past 2 years, where they just flooded the economy with $7 trillion over 30 months, which has caused massive inflation now. And now they're going to have to pull a lot of this money back out of the system while raising interest rates to get this under control. Without access to easy money, it says, at near 0% interest rates, banks are less enthusiastic about making loans. And this is going to result in marginal companies no longer being able to hold off financial trouble by refinancing, or taking out new loans because banks are reluctant to make loans, or the interest rates are too high for these companies that they're just not going to be able to do it. Now, commercial Chapter 11 filings have increased 141% in November compared to last November. So they're up 141% this month, last month, November, compared to last year's November, up 141%. Ordinary people now are going to pay for all this money printing, the 0% interest rates for over a decade. They're now going to pay. You know, people just thought that everything was going to be fine. Their credit card rates were much lower. They could go out, buy a car with a low rate, an RV, an ATV, a UTV, a boat, whatever, a camper, anything, a dirt bike, anything with these low rates. Those days are over. So what are all these companies going to do now with these RVs and the boats, the campers, the UTVs, the ATVs, all of this stuff? What are they going to do? The real economy is not built on endless bubbles, ladies and gentlemen. It's built on investment rather than spending made possible by artificially low interest rates and easy money. People didn't go out and buy all these toys because they were making so much money. They went out to the Bass Pro Shop and they bought a pontoon boat because they didn't care about the price of the boat. They looked at the monthly payment of the boat. They went and bought a jet ski. They didn't care that the new Kawasaki was $10,000 for a jet ski or whatever they are now, maybe even more. No, they looked at the monthly payment. Oh, wow, you know, $199 a month. Oh, I can afford that. Just think, still paying on this stuff 10 years later. You know, where will you be in 10 years and you still have a jet ski payment or a boat payment? I don't know how people get bamboozled into doing this stuff. I guess that everybody just wants to have a good time. Everybody wants to live like a rock star, and they don't think about, you know, 5 years from now, 10 years from now, still having these payments on a depreciating asset that, you know, breaks down, needs repairs, you know, needs a vehicle to tow it. You got to have a place to take it to, all this stuff. But all the easy money, the cheap money made it so tempting. Same thing with homes, right? Wow, this house is $800,000, but we have a combined income of $125,000, and the house is $850,000. But, you know, we can, you know, if everything goes perfect, we can make the payments. Is everything going to go perfect in your life in the next 10 years without, you know, an emergency or some kind of, you know, speed bump? There's things that come up, and people are stretched so thin. There's paycheck to paycheck, and now not even paycheck to paycheck. They're paycheck to buy now, pay later, to payday loan, to bridge to the next paycheck. If their kid falls down and needs, you know, 20 stitches at urgent care and it's $800, they don't have it. They got to put it on the credit card. People are stretched, and many people have only themselves to blame for this. There's a lot of people out there that I do feel sorry for because they're hardworking and prices of everything have gone up and it's affected their life. Not because they went out and bought a boat or a jet ski or lived beyond their means. Things just went up, and maybe they had a little bit of bad luck. Maybe somebody got sick. Maybe the kid had an accident. Maybe the car broke down. They needed $4,000 for, you know, a transmission. And these things happen, but they didn't go out. They weren't blowing their money on vacations and good times and you know, jewelry and boats and all this nonsense. And there's nothing wrong having nice things. Don't get me wrong here. There's nothing wrong having nice things as long as you can write a check for it or open up your wallet and pay cash for it or have very minimal payments. There's nothing wrong with it. As long as you have a cash reserve, you have assets, your debts are paid. There's nothing wrong with, you know, going out and having a toy or having a good time. The problem is too many people are going broke trying to look poor. They're going broke trying to feel, they're going broke trying to look rich. They're going broke trying to feel rich. And so this is the problem. You know, they go out and they buy a $10,000, $20,000 watch. You know, they make $50,000 a year and they just drop over $10,000 on a watch. This is not wise. You know, people just living so far over the means. These are the people who I have an issue with, because these are the people that want you to look at them. They're the people on social media. They're the people driving cars that they're paying over $1,000 a month on. These are the people who cannot afford this lifestyle, and they're going broke trying to look rich. They're going broke trying to feel rich. They're going broke trying to impress people they don't even know. Don't get sucked into this mentality. Don't get sucked into this lifestyle, ladies and gentlemen. This is the worst possible time to be doing anything like that. Make money, put it away, save it, wait for the opportunities that are coming. Make sure that you're working on yourself, your skills, becoming a better person, becoming in better shape, mentally, physically, spiritually, and financially. These are the things you're going to need, the skills and the assets you're going to need to get through what's coming. These people who are out trying to impress everybody that they're somebody, that they're rich while they're going broke, these are the people that are not going to survive what's coming. These are going to be the victims of the Great Depression. These are going to be the victims right here, not you. Be humble, live below your means, and you will be rewarded. God bless. Have a wonderful evening. As always, I look forward to speaking with all of you every day. I really do. I feel blessed to sit here and be able to speak with all of you. And you may not agree with everything I say, and that's okay, because I'm just letting all of you know what I'm doing, and I'm just sitting here thinking out loud with all of you. Please comment down below. I want to hear your thoughts. I want to read your thoughts, and I know that thousands of people want to read your thoughts and what you're seeing in your communities, how you're preparing for this. Are you seeing layoffs? Do you have friends, family, relatives who have been laid off? What do you think about 2024? Are we going to see a lot of layoffs? I think we're going to. I think a lot of things are going to happen. I think a lot of people are very unprepared for what's coming, and I think a lot of people are underestimating just how bad things are going to get. And the more prepared you are, the better your chance of surviving, not just surviving, but prospering during the worst of times. So I'm going to leave it there today. God bless every one of you. Thanks for tuning in. Like, share, and subscribe.